Now, that's called a straight pass-through security. But there are some mortgages, this was more common before 2008, just because somebody doesn't qualify for federal standards doesn't mean they can't borrow. They can, as long as they're willing to pay high interest rates. And these are called subprime mortgages. Back in 2000, before 2008, these subprime mortgages were being originated with almost no documentation. And banks had no problem doing it. They also pulled them and sold to people. The trouble is, how are you going to sell crack? I mean, these were mortgages where interest rates were over 10%, and standard mortgages were around 4 or 5. If somebody's willing to pay that much more, you gotta be concerned, right? Yes, it is backed by real estate, but given that real estate values are also variable, it's a problem. How are you going to sell these? There are subprimes. If you actually got these pools rated, you probably would have gotten junk rating or worse. The trouble with such a rating is, by law, you cannot sell it to pension funds. Pension funds cannot buy a debt security that's not rated AA or triple. By law, you cannot sell it to regular mutual funds. Mutual funds, where their main business is not to trade default risk, it has to be investment grade. Certain mutual funds, they do mix between risky stocks and cash, or stocks and bonds. They want to invest the bonds, but those bonds have to be investment grade. So how do you kind of do something that's going to allow you to put together this full of crap, but you're going to sell a piece to pension funds, sell a piece to mutual funds, and the rest is the people who want to take risks. You can do what we call trenched asset-backed securities. So minimum, you're going to do a senior tranche, mezzanine, and junior, aka real crack. So let's say you put 70% in senior, 20% in mezzanine, 10% in junior. Even though all these are backed by same pool of assets, which are the mortgages or the cash flow that emanates from those mortgages, these tranches are not created equal. There is a seniority in terms of cash flow. Whatever cash flow that comes in, the first 70% is going to go to, or 70% of the expected cash flow is going to go to senior tranche. So let's just say, for the sake of argument, expected monthly cash flow is $10 million from this asset. The first $7 million that comes in is going to go to senior tranche. If it's less than 7, the other 2 tranches get nothing. Then think of this as level pools. Senior tranche is the pool at the highest level. Water comes in, fills that pool. Once it's full, it basically overflows and goes down to the next level, which is the mezzanine. So if more than $9 million comes in, both senior and mezzanine are going to be paid fully. Whatever that is left, if there is anything left, is going to go to the junior. If you work with these numbers correctly, you can actually, you kind of do a bargain with the bond rating companies. You can have this rated AA, you can have this rated triple B. You work around those numbers so that actually happens. Double A allows you to sell that senior tranche to pension funds. Triple B allows you to sell the mezzanine to regular mutual funds. The rest, you may have clients who really want to bet that the real estate market is going to do well and do that on a leverage basis, or you can keep it for your books if you can sell it. With mortgage-backed stuff, the only risk, even if there is default, that's a lot of the quality goes down. But if real estate prices are going up, I don't particularly care whether these guys pay their mortgages. Because I'm going to foreclose, I'm going to sell it in the market and cover the loan. Done. But in 2008, in places like Florida, Tallahassee, for example, loss in value was around 40 to 50%. That means even with 20% default rate, remember these are subprime, you're going to lose a lot of money. Because 20% are going to default, okay? Of those, you're going to cover only about half of what you were expecting. So you're going to get 90% of expected cash flow. Junior tranche is gone, right? Companies like Merrill Lynch did a lot of these things. As long as the real estate prices were going up, those junior tranches double, triple in that. If you look at the earnings of Merrill Lynch in 2006 and 7, it's humongous. The guy who was running the global fixed income got a bonus of $175 million in 2007. The reason I know this, the guy who replaced him, this guy retired after that, was a friend of mine, and 6 months after that, Merrill Lynch was wiped out because of this. Again, financial engineering, if you know how to use that instrument, you can make good money. If you don't, you'll be wiped out. The reason Merrill Lynch and Bear Stearns and Lehman were wiped out, they were implicitly highly leveraged. And typically in investment banking, your funding is overnight to week basis. So if you can't fund yourself for another week, you're dead. When Lehman went down, they were leveraged 30 times. You know what that means? If for every $100 of assets they had, for every $30 of assets they had, $1 was theirs, $29 was borrowed. That means if the value of your assets go down by more than 2%, your entire capital is like that. Done. And these things are quite good, especially in crisis times. And we will also talk about how to use these for risk management purposes. And towards the end, we will also talk about how to do the accounting for these things. Of course, we're going to talk about valuation and so on and so forth. I don't want to get started on anything serious today. On Monday, we're going to do an introduction to a generic approach to valuation of derivatives, but particular evaluation of the options, and in simple cases, and go into more complicated stuff. Right? So on Monday, we're gonna learn how to value simple options, calls and puts. And we'll go from there. There is no textbook. Did I say there's no final exam? Or there are no exams anyway. I kind of started doing that during COVID times. I kind of stuck to it. Any questions you guys have? On Monday, once we are sure that there's still 10 people, I'll divide you guys into groups so that you can think about how to cooperate when you do the group. And I'll see you guys Monday.